welcome you and thanking you for joining us for the Echelon Research Top Picks Portfolio presentation. My name is James Hunter. I'm the Head of Wealth Management at Echelon, and I'm really happy to see that we have representation on this call from a number of different locations in Canada. We are a national firm from Victoria and to Montreal, in branches anywhere between there. And we've got clients from each of our locations on the call tonight, which is very nice to see. Obviously we would much rather be doing this on a sunny patio with a cold drink in hand and warm appetizers being passed around. But Zoom has become part of our regular life now, and we're sort of doing the best we can to bring information to you, our valued clients, and as meaningful content as possible. So we're looking forward to, in the very near future, hopefully, with vaccinations going the way they are and the success we're having there now, to seeing you in person very shortly. So I would like to introduce to you now Rob Goff, who is the head of research at Echelon. Rob's got a very strong team of analysts. Rob himself is a player coach. He's an analyst as well as running our research department, and was in 2020 ranked amongst Canada's top 5 analysts, which is incredible. And I should also mention that Andrew Semple was awarded Best Performing Canadian Analyst. So at Echelon, we've got some very, very strong, highly intelligent, highly plugged in analysts that definitely benefit our client portfolios. So I will hand it over to Rob now. His team this evening will be covering off the mining sector, life sciences, cannabis, technology, real estate, and specialist situations. And so, Rob, with that, I'll hand it over to you to give a review of how the Top Picks portfolio has performed and some of the insights into the current positions. So, Rob, over to you.
Thanks, James. I would like to echo James's thanks and words of welcome. The Echelon research team is very pleased to have the opportunity to discuss our Top Picks portfolio. As we present, please feel free to ask questions in the chat box, which only the panelists will be able to see. We will answer a few of them, but as time is limited on the call today, we may not be able to get to all of them. Feel free to reach out to your advisor after the presentation for further questions on any of the companies, or for copies of our fuller research reports where we go into each of the companies in much greater detail. The research team first introduced the Top Picks portfolio over 5 years ago, and we are very proud of its exceptional track record across the period. Before diving into the performance of the portfolio, we would like to highlight, first of all, for everyone on the line, that the portfolio is best considered as a high risk, high return portfolio. In terms of screening names for their inclusion, we are flexible. However, we do prefer companies where they are operating in growth sectors or have growth opportunities by resource base. We look for stronger management, typically founder or founder type management. We look for catalyst-rich names. This is a particular focus for us. We tend to get a strong mix of consolidators and in turn acquisition targets. In fact, takeouts have recorded numerous wins for the portfolio over the years. I'll turn the slide here, skip over a couple things to our first performance review graph, where we track or we highlight the near-term relative outperformance before getting into the admittedly much more important longer-term track record. For Q1, we saw an impressive 27% gain, outpacing both the TSX Small Cap at 9.7% and the broader TSX at 8.1%. Fortunately, our outperformance has continued in the second quarter to date, where the portfolio itself is ahead by 9.5%, outpacing the small cap peers 5.1, and the TSX at 3.9. While graphs, are very visual and grab your attention, we prefer the meat of the table. And in terms of the table before you, you can see where for 2020, your portfolio returned 74%, while the TSX was 5.6, the TSX Small Cap was 12.9, and then putting things in a North American context, S&P 500 at 18, and the Russell at 20.0%. Whenever I put up this slide, Stéphane Quenneville, who joined us to cover the life sciences, but was previously a portfolio manager at CI Funds, he always points to Q1 during the year, where we declined by 26%. And he highlights that that is a notable performance given the high beta, high risk profile of the portfolio. For us to be down by 26% against 21% for the broader market, that was a very significant performance on the portfolio. Now, getting to what really counts, the longer term results. Over the 3-year period from 18 to 20, 110%. We give you the TSX at 18, and small caps, which had a very difficult time until the recent strength, it had just a modest 7%. 5-year numbers from 16 to 20, up an impressive 431%. So we are very pleased with both the consistency and the sustainability of that outperformance by the portfolio. On the slide here, we present to you our Q2 portfolio. You will note on it in shading, we have 3 names out of 13. Generally within each quarter, we run about a 12 or a 13 company portfolio, so it's concentrated. Generally 3 to 4 names are introduced with each quarter. So there's a fair bit of turnover. There's definitely a high degree of concentration in the portfolio. In terms of the names here, you will see each of the constituents. You will see price targets associated with each, and you will see very aggressive returns that stand out. And what we would urge you to consider is that in many cases, these price targets and implied returns reflect on prospective catalysts rather than just ongoing operations. And that is the nature of our portfolio, where we screen for catalyst-rich names. Now, jumping into the first sector, telehealth. Bellwether names such as Well Health and CloudMD that are well known to everyone on the call here. They returned an impressive 416% and 570% respectively for 2020. However, that was 2020. The shares of the 2 names have since seen declines of 15% and 22%, leaving for the year to date, leaving them down 30 and 46% below their 52-week highs. We also saw a number of peer IPOs exiting 2020 and the start of 2021, where they have experienced similar declines or steeper declines, don't have the benefit of the initial run. Our view is strongly bullish for integrated healthcare providers. We look for diversification across care solutions. We look for strong technology platforms, and we look for vertical integration. Vertical integration means you own the patient. It's periodic, ongoing care, not just drop by or walk in. We firmly believe in a sustained run of outperformance for such companies, or essentially, we see continued growth in demand for what's a broken healthcare system. And this supports, within this context, we see an evolution in care where technology is the key enabler, where supply meets demand, patients receive better care, physicians are happier, politicians are happier because of wider access to care. Now, recognizing time, we want to jump into our first name, that being Skylight Health. It is a speculative buy stock. It has a price target of $2.10. The company is recognized as a consolidator of primary care clinics in secondary markets across the US. We are very bullish on its ability to acquire on accretive terms and then quickly reposition these clinics to drive organic growth. By focusing on secondary markets, Skylight is able to acquire on attractive terms, while secondary markets offer arguably greater organic growth by simple things such as introducing specialty care or more proactive patient scheduling. Furthermore, patients are more loyal, physicians are paid less, and billing fees are standardized. The company has announced it expects to list on NASDAQ within the month of May. We see this supporting a positive revaluation for the shares as it gets more attention, more eyes, and as the US comps become very apparent. CloudMD, it also is a speculative buy. It has a $4 price target. On this name, the company has aggressively repositioned itself with private enterprise now representing 44% of revenues. Technology and digital services are at 40%. Clinics are at just 16%. And even that is overstated in that half of clinic revenues are virtual, i.e. technology related. Essentially, the challenges of public care are driving ahead private care, where the economics provide attractive financial returns for employers before considering the positive employee benefits. To explain, with public care, many employees are wasting time lining up for drop-in clinics where they simply get a referral. With private care, they're more apt or more likely to get a virtual triage that directs them to a relevant specialist at a specific and convenient time. Thus, time savings alone are supporting very attractive economic paybacks for employers. And we are very encouraged to see CloudMD reposition its portfolio with such leverage to this market. In terms of markets, we look for further expansion into the US and a prospective move to Europe to drive the shares ahead. Now, as we jump ahead, Amber and myself cover off the technology and diversified industries. The first context or perspective statement was put forth by Microsoft on the IT services, where simply put, they said they had seen 2 years worth of digital transformation in 2 months of the third quarter of 2020. The company has then gone on to report cloud revenue growth of 47% for Q4 20, 46% for Q1 21, respectively. It's a very positive tailwind for the IT services space. And it's within this context or backdrop that we have both Converge and Quisitive in our portfolio. Converge, it is a speculative buy. It has a 1050 price target. Our view here starts with the organic growth, where we look for double-digit organic growth. We then look for inorganic growth, where the company, we have a certain mantra that we describe for the company, where we say the stock is a copy, paste, accrete, repeat, or rinse and repeat. The company acquires in non-competitive situations. They've done it 19 times on accretive terms since just October of 2018. Once they acquire, they quickly boost revenues through cross-selling higher margin services. Because of their scale, they're able to get discounts on equipment. And because of their scale, because of their muscle with the vendors, they're able to take payables of 40 days to 75 days. The equation here means they are able to get acquisition valuations down to 3 times EV to EBITDA on a prospective basis. And it gets better. By the working capital freed up, By the earnout structure, over half of the acquisition proceeds are typically covered. In terms of catalysts, we look for the company to acquire in Germany shortly. We look for the company to potentially list in London later this year. We see both as being positive in terms of revaluation or a further revaluation of the shares. Now for our second IT services name, this being Quisitive. We have a speculative buy, a price target of 275. The company in a nutshell, essentially is 1/3 an IT services company, 2/3 a payment processor, 100% a Microsoft company. Microsoft refers business to them. Microsoft refers target acquisitions to them. Microsoft engineers work side by side with the Quisitive engineers. So we like the IT services, both for its organic and inorganic growth. We are particularly aggressive about the launch of its next generation payments platform, where universally vendors do not like their payment processors. LedgerPay, which is the division within Quisitive, is coming out with a next generation solution. Give it a small market share and the stock is returning very nicely for investors. As with their other names, outsized management. Management talent is exceptional. I'm now very glad to hand it over to my colleague, Amer Izat, where we have given him the chance to discuss a non-top pick portfolio name, as he is somewhat hamstrung, restricted on Photon. And before giving Amer the mic, I will note that both Amer and Ryan Walker in particular have seen a number of their coverage names taken out. As an analyst, it's a mixed blessing. You love to see investors make money. You love to be a hero for a day, but then it's on to the search for the next name. So with that, over to you, Amer.
Great, thanks, Rob. Yeah, no, I'll echo what you said. It's always like bittersweet when there's a takeout. I'll also echo what James and Rob said and welcome everybody and thank you for joining us. So yes, restricted on Photon, but I'll give you the lay of the land on what they do. I'm allowed to speak to that. You know, like Photon is the poster child of what I look for in a company, in that they're relatively unknown to the wider market. And when a company's really undercovered, it means it's usually cheap and it's an opportunity to make money. They've got a very clean balance sheet, no debt, very strong management team. Best of all, they're in a tremendous industry with very strong sales and earnings growth, which we love. What the company does, like very simply, is fiber optical temperature sensors that are used in the production of microchips. So it's a play on the semiconductor industry. And when you think about the long-term drivers there, it's artificial intelligence, big data, cloud computing, the fact that everybody's like video streaming, the deployment of 5G networks, and so on and so forth. All of these trends are helping drive record demand for chips. And when you're thinking about these chips, they're getting like smaller and smaller in nature and much more complex. And the example that I like to give is the Apple chips. When you look at the Apple chips currently, they've got 9 billion transistors in them. If you go back like 3 years ago, it was only 3 billion transistors. So we tripled the number of transistors on a single chip. And that's where photon control comes in. What they do is like their temperature sensors are engineered into the systems that produce the microchips. And when you're going through the production of semiconductor, if you're overcooling or overheating chips, you're scrapping a great deal of inventory. So their product is extremely mission critical. It's mission critical to guys like Intel, like Samsung, like Taiwan Semiconductor, which manufactures the Apple chips. So early last week, MKS, one of the big players in the industry, announced that they have agreed to acquire Photon for $3.60. Our corporate finance group advised on the deal, hence why we're restricted, but it's been a top pick for a while, and you sort of see the stock chart, a beautiful stock chart there. It went from $1 last year to $3.60. We were the first guys to launch coverage in this name, and we were the only ones for a very long time in October of 2015, and it's a 420% return since. It's also the fifth stock I've had in my coverage taken out, and that's the list. Two of them were top picks, actually, and the other two, we were the sole analyst on them. So it goes with the theme of looking for undercovered stories, which is really my mantra, at least. Okay, so we'll move on to the second stock that I'll speak to you about. It's not officially a top pick, but I had to nominate an idea to replace Photon, and that idea is ReadyShred. So it's got a $1.10 target, 80% return from yesterday's close. 60 million market cap, so it's smallish and unknown to the wider market. Again, a bit like Photon when I started covering it. And what they do is extremely simple. It's shredding services. So they go to offices, put in like their paper bins, then they come and shred these documents every month or every quarter or every half year, depending on what businesses want. So if you look at the stock charts, it's obviously a story that's been hit by COVID. The stock hasn't fully recovered yet. So if you've got a 1 or a 2 year time horizon, we think this stock is a no-brainer. They're 100% exposed to the US, and obviously the US is reopening. So you do assume like some sort of like return to work, not like before, but just a bit, and just assuming very conservatively a bit of that return to work, we see like tremendous upside. Best of all, we think it's extremely cheap. So if you compare it to companies in the industry, it's 40 to 50% cheaper. Only ReadyShred is growing their sales at 20% a year when peers are either in decline or not growing at all. And maybe that's a good segue to sort of explain the philosophy of how we approach topics. It's not always looking at upside, but really looking at upside's potential relative to your downside risk. So if I've got a stock that's maybe a double, but they've got a lot of debts and it's high bankruptcy risk, it's not really a top pick. It's not really attractive. For ReadyShred, that upside to downside ratio is 3-to-1, which is exceptional. One of the big questions I always get about ReadyShred is why buy ReadyShred when people are printing less? Now, what they're doing actually is organically they're growing at 8% a year, and that's because they're cross-selling other services that are extremely high growth, such as shredding electronics, or what we call e-waste. So they'll take your servers, your electronics, your computers, your hard drives, and so on, and shred it into thousands of pieces. They'll also help you digitize all your printed documents and organize it for you. That's also got like tremendous growth. The third leg of growth is they've got a lot of franchises that they're buying out. That's like a pretty low risk roll up strategy, in that they're consolidating operations that are already using their trademarks, where they have access to all of the financial history, they've got all the KPIs, they know the management. So, you know, like it's a pretty low risk roll up. And through that roll up strategy, we foresee them doubling their sales. So we really like this story, not officially a top pick, but close to it. With that, I'll pass it on to our top analyst, Andrew.
Thank you so much, Amber. Appreciate that. And good afternoon, everyone. You know, I'm glad to be here today to walk through the top picks portfolio and in particular my cannabis picks. You know, before I delve into my three names, you know, I would like to give just some general comments on the cannabis industry. First and foremost, the cannabis industry is very broad. You know, there's dozens of ways you can choose to participate in it. You know, there's over 150 publicly traded companies that operate in some way, shape, or form in the cannabis industry. You can segment that by geographies, by the part of the vertical of the supply chain that these companies operate. Some are wholesalers, some are retailers, some are distributors. Or you can have more of a focused approach where some companies focus on the medical market, some on adult use, and some focus on hybrid opportunities. By and large, although there's 150 listed companies out there, we have taken a very focused approach with our cannabis coverage. We have almost exclusively covered only U.S. cannabis and Canadian cannabis retailers. And so, I like to think that all of my picks are top picks because of our focused approach. But there are a handful that I think stand out even so from that group, and I'd like to be able to discuss some of those opportunities with you guys today. So first and foremost, I want to introduce a new top pick this quarter, and that would be Columbia Care. Columbia Care we nominated as a top pick this quarter as we were really impressed by the company's recent traction in accelerating its organic growth, namely through significant capital investments in upgrading its production and cultivation capabilities. We have also seen very good evidence coming out of some of its key markets, such as Florida, but also some of its key markets transitioning towards adult use sales, such as New Jersey, Arizona, New York, Virginia. And we didn't feel like all of these positives were being captured or reflected in the share price. And so we thought that the second quarter was an opportune time to make it a top pick, where we've seen all this evidence of the business fundamentals improving. And yet, I think you can get, I don't think that was fully captured in the share price as of today. And so when we look at the company in the year ahead, we think 2021 is going to be a very catalyst-rich year for Columbia Care. We look forward to it closing its pending acquisition of Greenleaf Medical. We think that is an excellent transaction completed at mid-single digits of 2021 EBITDA contribution. As that business grows, that will only look more and more accretive over time. So we are huge fans of that deal. We think New York adult use is just starting to come into focus. We don't think the share prices of many operators have fully reflected the upside of that market. We note in our most recent note that incorporating adult use into our DCF valuation in New Jersey and Virginia would add $1.50 to $2.75 per share to our price target based on fairly conservative scenario analysis. And finally, we think the business is going to see improved financial results this year. The company just reported Q1 results, a little bit weaker than expected, but which showed a strong 13% quarter over quarter sequential sales growth. So all in all, we think this business is very much improving. And when you look at the valuation multiples you pay for this business today, Columbia Care currently trades at 10 times our forward EV to EBITDA estimates compared to the average peer group at 14.5 times. So, very discounted to the peer group, although you have all these emerging opportunities in New Jersey, in New York, in Virginia, and in Arizona. So following that, we decided to make Columbia Care a top pick. And we can move on to the next one. So Air Wellness. Air has been a top pick for us since Q3 of 2020. We nominated a top pick as we made a non-consensus call that this company would be able to accelerate and announce M&A when we think the market was really not anticipating this at all. You can see from the share price chart there that Q3 top pick was very fortunately timed. We caught a very nice upswing, but the company still has one of the most compelling valuations in the US cannabis sector. The company remains heavily discounted to peers despite its very strong share price performance. It trades at 6.9 times our 2022 EV to EBITDA estimates, again, compared to the large cap MSO peer group at 14.5 times. We do not think this steep discount is warranted at all. Many of its recent M&A deals we think are home runs, incredibly accretive to the business. Again, at mid-single digits of forward EBITDA contribution. We don't think there's too much execution or integration with risk with these operations. We feel we have a very clear line of sight to profitability to come imminently from these transactions. And so we look forward to the company's Q1 results, which should be reported next week. And again, we highlight the company's very strong valuation, or very attractive valuation at these levels. We continue to think it's a great entry point for new investors. And then moving on to our third top pick, Green Thumb Industries. Green Thumb has been a top pick for Echelon now for 7 consecutive quarters. We have held on to our call on this name as we continue to view it as an exceptionally strong operator, probably the best managed company in the US cannabis industry, and by extension, the global cannabis industry. The company has outperformed its peers on many metrics. I think primary importance is its organic growth over that time period. It continues to outperform financial expectations on the pace of its growth as it continues to find new opportunities to invest in its existing portfolio of licenses. We note the company also continues to be very active with M&A. We noted that as a catalyst for this quarter. And in this quarter, we saw Green Thumb make its move into the Virginia cannabis market. Again, that's a population of 8 million people that just approved adult use sales, which is set to start in 2024. So the business continues to add to its exceptional high quality portfolio. And we view this as kind of the high quality, more defensive name of our top picks that will continue to outperform in the long term. And when we look at the valuation multiple, the company trades at about 14 times our 2022 EBITDA estimates. We think for a vertically integrated business that offers a long runway for growth, that is very well managed, that has multiple years of demonstrating that it is a very sound and savvy capital allocator. We think that this is a very reasonable multiple that offers tremendous upside from here still. We note that there's programs, there's adult use legalization in New York and Virginia have not been incorporated in our model for Green Thumb. So that offers upside to our valuation. We also do not incorporate potential M&A, which could result in upside, and we don't incorporate federal cannabis reform in the US, which also offers upside. So it continues to have a very attractive risk reward profile for a leading cannabis business. And with that, I'd be happy to turn the call over to Stefan to walk through our healthcare picks. Over to you, Stefan.
Thanks so much, Andrew. It's always tough to follow Andrew given the great performance of his stocks, but I'll do my best. We have 2 top picks for the quarter. We're keeping Quipt Home Medical, although that sounds like a new name on the list. It's it's changed its name. It used to be called ProTech Home Medical, and they did that as part of the rebranding for listing on the NASDAQ, which is a key catalyst for the quarter. And we're adding a new, I guess a second new name, but a new stock, in this case, a Diagnose. And the reason for both of these is that we think they both have meaningful upside from potential catalysts in the next few months. So I'll start with Quipt, once again, formerly known as ProTech, with a 1060 target price and 26% upside. So the company's up about 40% since we initiated on it as a top pick at the beginning of the year, but we still think the company has upside from potential M&A opportunities that we don't give them credit for in our valuation. For those of you who don't know the company, they provide durable medical equipment for at-home care of respiratory patients. So think of things like ventilators for people with COPD or CPAP instruments for people with sleep apnea. So the business has 3 major drivers. The first is, very strong demographic tailwinds from the aging population that drives organic growth, sort of mid to high single digits annually, and that's going to go on for the foreseeable future because of the aging population. The second, and it's a key part of their business, is that it's in an M&A sweet spot due to the industry structure that they have. So the DME industry, the durable medical equipment industry in the US, has basically only a handful of large national players, about a dozen scaled regional players, of which Equipped is one of them, and about 6,000 small mom and pop players with revenues of under $20 million. So what that allows for is, Equipped has a long runway of small accretive acquisitions they can make at sub 6 or 5 times EBITDA prior to synergies, without a lot of competition. So that's a really key part of their growth strategy. And thirdly, there's an ongoing shift to at-home care, which Rob talked about meaningfully with his telehealth names. Obviously, this is was accelerated by COVID, but it will last well beyond the pandemic because patients prefer it. But even more importantly, it provides cost savings to payers like Medicare, because it's cheaper to care for someone at home than it is in a hospital or nursing care center. So the key catalysts for the stock are potentially accretive M&A, which they've done consistently over the last couple of years and have been very successful at. And we don't really have that in our numbers, so there's upside to our numbers from that. And the other one is that it's in the process of listing on the NASDAQ, and for that reason, it's changed its name and did a 4-for-1 stock consolidation. So we expect that to occur during the quarter. So the company trades at just about 10 times EV/EBITDA, which is a discount to its peers at about 13 times. So we value the company at around 12 times, at 12 times, which results in our 1060 target price and 26% upside. Moving on to Diagnose. So Diagnose is an 85-cent target price and 60% upside. Diagnose is an artificial intelligence company with a platform to diagnose diabetic retinopathy. Diabetic retinopathy is the leading cause of blindness in adults. It occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the retina in the back of the eye, which leads to vision loss. The process is asymptomatic, so you don't feel it happening. And the only way to identify the problem is by taking a picture of the back of the eye, the retina, with a special camera. And then the doctor grades the severity of the blood vessel proliferation. So Diagnose has developed an AI system that does this extremely well and very efficiently, and in some cases, even better than doctors. So there are about 450 million diabetics in the world, and they're all supposed to have a retinal exam once a year. So this is an over $1 billion opportunity for the company should their system be adopted much more broadly in the marketplace. The company has a number of partners that are using and piloting their technology that was hit pretty badly by COVID because it's kept a lot of eye clinics and optical retailers closed. We think that with vaccinations that are happening, things will start to open up slowly over the summer. But even though the business sort of came to a standstill over the last year, they've used a lot of their time to do a lot of business development, and they're working on winning some meaningful contracts targeting optical retailers, governments, and insurance companies sort of around the world. So we know that they've been very busy and they're working on opportunities both large and small. And we think that over the next 3 to 6 months, the company could have some meaningful contract wins that will really be catalysts for the stock. So we value the stock at 85 cents based on the average of our DCF and our EV to sales valuation. It trades at about 7 times EV to sales relative to health IT peers at around 10 times. So that gives us about 60% upside to our target price. So with that, I will hand the call over to my colleague, David Crystal. He's the newest member of the team who will talk to you about real estate.
Thanks, Stefan. So we'll shift gears into the real estate sector. As Stefan mentioned, new to the firm, but definitely not new to the real estate space. At a very high level within the real estate sector, we're very bullish on the multifamily space for several reasons. First of all, it's a very defensive asset class. It's weathered COVID-19 exceptionally well. Second of all, apartment owners have access to cheap and widely available government-backed debt financing, which is an extremely attractive competitive advantage for the sector. Third, there's an astronomical amount of capital bidding up the underlying asset values. And fourth, and very importantly, public market valuations have not yet regained their pre-pandemic highs, although private asset values are and continue to trade at all-time highs. So with that as a backdrop for the real estate space, I introduce our top pick, Killam Apartment REIT, with a $23 target price and 23% upside return to our target. Killam's the dominant residential landlord in Atlantic Canada. They own a portfolio of 17,000 apartment units and 6,000 manufactured housing community sites. The REIT generates about 70% of its NOI from East Coast markets, and it's the dominant landlord with 13% market share of apartment inventory in its 6 largest East Coast markets. So very tilted to Atlantic Canada. We like the story for a handful of reasons. First off, East Coast apartment fundamentals have never been stronger after historically lagging Central Canadian markets and Western Canadian markets. What this looks like is population growth that outpaces the national average and that of other large metro areas, apartment vacancies that is at or near historical lows in its core markets, particularly Halifax, rent growth that's hitting 30-year highs for the region. And we've all seen the home price appreciation across the country. It's actually substantially higher in Killam's markets than other major metros. So in their 6 core markets, home prices are up between 30 and 60% year over year, which compares to some of the topical markets that you constantly hear about. Vancouver up 12%, the GTA up 18%, Ottawa, Montreal up 27, 33%. All of these should drive strong organic cash flow and asset value growth. And in our view, it positions about a 5% plus baseline in per unit asset value growth. Second of all, they've got a value add approach that should drive incremental additional NAV per unit growth. They've got a $1.2 billion development pipeline, which should contribute $2 per unit to NAV over the next decade. This is about an incremental 1% per year, just based on developments they've identified. And they've got 20 million of annual suite repositioning and green energy initiatives that should add another 20 to 30 cents per unit of NAV annually. So there's another incremental 1 to 2% above just the fundamental growth. And then the final reason to like the story, it trades at a significant discount valuation to its peers, and in our view should see a re-rate. At the current valuation is 24 times EBITDA versus 27 for the peer group, or 18 times funds from operation, which is the typical REIT earnings metric, versus 24 for the peer group. Historically, if you look back the period 2011 to 2014, they traded in line with their peers until there was a significant divergence in fundamentals between Ontario and the west side of the country versus the East Coast. And then you really saw the trading multiples diverge. In our view, with East Coast fundamentals showing signs of strength, we would expect to see cap rate compression in their markets, which should drive their asset values higher. And a 25 basis point compression in cap rates would drive a 10% bump to NAV, or in other words, a 10% bump to value per share. The spread currently between Killam and their Ontario-centric peers is 100 basis points in terms of implied cap rate. So we're not calling for a complete elimination of the discount valuation, but if you were to completely eliminate the discount, you'd be looking at a 40% plus bump to NAV. Just narrowing it slightly would drive a 10 to 20% NAV bump. So in summary, in our view, the REIT's very well positioned to deliver double-digit returns through organic NOI growth, its value-add initiatives, a 3.5% distribution yield, and any valuation re-rate would definitely boost this figure by 10% plus, if not 20% or greater upside. And with that, I'll pass it over to Ryan in the mining space.
Great, thank you, David. So as Rob mentioned earlier, we've had more than a few names taken out of our universe via M&A, and really that just kind of comes with the territory. With our MO being essentially we look for the next crop of development projects for the mining sector. Kind of an enduring theme has been, in the last, say, better part of 10 years, a real underinvestment in grassroots exploration in particular, and that's really left the development pipeline pretty bare. So we look for those projects that we think are meaningful enough that the intermediates and the large producers will come in and backfill their development pipeline by taking these out. So I think since I've been at Echelon, we've had maybe 5 or 6 names taken out, and during my career, I think we're up to about 14 or 15 now. So I think we've kind of got it down to a science, and we really believe that our top pick for this quarter, Osino Resources, represents another takeout target. So Osino, we've got a spec buy 250 target. It's trading at about $1.36 currently. It's up about 19% quarter to date. And really, so let's boil it down. Why do we like this one? There's kind of a key checklist that I go through, and number one is proven management. Hi, Don and Alan Freeman, co-founders here. It's very much a rinse and repeat story. They sold the Otjikoto gold mine in Namibia to B2 Gold back in 2011. Just let's rinse and repeat. So they've moved about 100 kilometers to the south and have made a new discovery at the Twin Hills Central project, and are drilling that off now. And really the game plan is the same, build this thing up and sell it off. So proven management, and really you can't overstate that in the junior mining sector. Solid management is paramount. You can have the greatest project in the world. If you don't have the management to steward it through the various channels, you might as well just forget it. The second thing we like to see is scale and scalability. And again, Osino's project has that. They came out just recently with a maiden resource, 2 million ounces. So a nice large resource, and that's on the first target of many here, and on a very large land package. So lots of upside left, 2 million ounce starter. Anybody will take that as a starter. Number 3, jurisdiction. Fine, you've got a great project. Can you actually do anything with it? So Osino, located in Namibia, a long heritage of mining dating back over 100 years. More traditionally, it was diamonds and uranium, but now becoming more of a destination for gold. Obviously, with Otjikoto, that the Osino management sold to B2 was kind of the flagship in that regard, and now Twin Hills Central being a big part of that. And then the company is well funded. Another consideration we look for, they've got about $16 million right now. To more than sufficient to carry out their very aggressive drilling plans this year. 100,000 meters of drilling with 9 drill rigs. 25,000 meters of that is pure exploration drilling. So trying to tap into some of that upside now that they've established their kind of critical mass, or their anchor deposit there at Twin Hills Central. So catalyst going forward. We don't hang our hat on M&A and takeout being the only catalyst. We've got the maiden resource estimate came out right basically on our expectations. We were looking for 1.5 to 2 million ounces. They came out at 1.9, so we're happy with that. We've got this aggressive drilling going on. So we've got the 2 million ounces. Let's see what some of these other targets can come up to. And they've got 11 targets within a stone's throw of that main deposit. So 25,000 meters of exploration drilling dedicated to just those. And then with this maiden resource that they've established, they'll look to do a preliminary economic assessment. So let's wrap some economics around this deposit. Can we mine it at a profit? And that will come out toward mid-year this year. And really, that's could prove to be the big near-term catalyst. That's when the founder's former company sold their mine to B2 Gold previously. So you get that project, you establish that resource, get some economics around it, secure whatever land you need, and at least, very least, get the project permitting rolling, and then somebody comes in, you've done all the heavy lifting for them, an acquirer comes in and takes you out. So obviously we think B2 is kind of the logical built-in buyer. They've got the history there, they've got an operation nearby, so there would be synergies. But again, we don't hang our hat on that. We think that the current management is more than capable of bringing this project into production themselves, and this would, for any junior, would be a company maker for sure. So that's really it in a nutshell for Osino. We look forward to these exploration drill results starting to come out now. We haven't seen any of them yet. Those could be, catalysts in their own right before we get the preliminary economic assessment by mid-year. So with that, I will pass the baton on to my partner in crime, Gabriel Gonzalez, on the silver side.
My top pick returning to the portfolio this quarter continues to be Silver Tiger Metals. I have a spec buy rating and a $1.30 price target, and I'm happy to say it's among the top performers so far this quarter. Silver Tiger has been drilling the past producing El Tigre project, one of Mexico's highest grade historical circa 1930s producers. Drilling is currently focused on several veins and the surrounding flat formation alteration halo, where the company has intercepted significant wide high-grade mineralization. Just over 60% of the company's current 83 million ounces of silver equivalent resources are actually in low-grade El Tigre gold halo alteration, grading only about 57 grams per ton. So there's a significant opportunity for the recently discovered mineralization to add higher grade ounces to the resource mix and thus lift the company's overall value. To give you a taste of what they're drilling, the company actually came out with drill results today highlighting a 3 kilo per ton of silver equivalent over 1.3 meters. So far, the highest grade intercept at the Benjamin vein. This is on top of earlier results from the Sui vein, where the flat formation footwall zone returned 12 meters of close to 700 grams per ton of silver equivalent, including 1 meter of 1.7 kilos per ton of silver equivalent. So these are exceptionally high grade intercepts with which to add potentially higher grade, higher value ounces to the resource estimate. The company has already delineated the Sui vein to over about 1,000 meters, and it has another 500 meters or so of strike at the Benjamin to infill drill. So I see this area becoming an important driver of value for the company. More importantly still is that the alteration horizon potentially extends to other areas of the property, such as below the El Tigre pit and the Sates Kelly vein. These are areas that haven't really been fully drill tested. The company recently completed a $23 million bought deal, which potentially allows the expansion of the current drill program and be continuously active in putting out news to the market to drive interest with. So the bottom line is that I look for the current drill program to increase total silver equivalent resources by about 80%, from 83 million ounces to about 150 million ounces. And the key again is a larger proportion of resources coming from higher value, higher grade mineralization to drive valuation upside with. The company remains relatively undervalued at an EV per ounce of just about $1.60 of silver equivalent based on current resources, versus the adjusted $2.16 per ounce peer group average. So my target and pro forma conceptual resource estimate implies about $1.71 per ounce of value. So there's still reasonable amount of upside potential to the story on top of my price target. So having covered that, I will return the call back to Rob and James for closing remarks and any Q&A.
Okay, and James, would you like to step in with the first question, or I can? And after queuing here, we would encourage where you have questions just to chat them, put them in using the chat function.
I'd be happy to, Rob. Actually, Gabriel, we should start with you. We've got a question here. Silver Tigers, share already doing very well. What do you think will be the next catalyst for the stock?
Sure. So, I believe continued drilling and results from these high-grade areas are going to be a very important catalyst in the near term. Looking out a little more to the closer to the second half of the year, I'll be looking for a resource update, which I think is going to be a significant driver of value. As I pointed out, significant upside to the resource is to be had with a potential resource update. And I think it really is, on top of everything else, also significant growth versus what you're getting from comparable primary silver development projects. So those are the main catalysts that I'm looking for.
And do you have any indication in terms of where the commodity is going?
Yeah, silver is it's a very interesting commodity right now. Partly it's a precious metal, and so it benefits from investment demand from investors looking for safe haven type investments, inflation type investments. But it also has a really interesting industrial twist to it. I would say about 50% of the commodities demand is from industrial sources, which is significantly more than, say, for instance, gold. And so that plays very nicely into the reopening trade and the inflation, reinflationary trade that's going on post COVID-19. And a subset of that is also that a growing proportion of demand, of the industrial demand, is coming from clean tech areas. So photovoltaics, for instance, use silver, and there's really no substitute for these silver bars in the solar panels that you see. Silver being really the best conductor out there is the key ingredient for high efficiency panels. And also we're seeing a pickup in demand from electric vehicles, just considering all of the electronics that go into electric vehicles and like all of the switches. Silver is very much being used for that. So lots of really interesting industrial demand coming down the pipeline for silver.
Great. Thanks, Gabriel. And by the way, don't feel bad. Our mining analysts are allowed to have technical difficulties. We get concerned when our technology analyst has technical difficulties.
Thanks for that, James. So hopefully that can be, the issue can be edited out. Thank you.
The next question is for Ryan. Do you believe that Osino represents a takeover target? And what would the potential timing be on that event?
Yeah, so that's always the trick, the timing. I definitely think it is a takeout target. It's got the size already. It's got plenty of upside left. So an inquirer, whoever that may be, can come in and kind of surface some value on it in its own right. And that's what happened when B2 Gold took over Otjikoto from Oryx, the kind of the precursor company here. They came in, did some exploration by themselves, and found some high grade zones and surfaced more value. So the timing's hard to say, but definitely think it's worthy and probably on a lot of radar screens going forward. There's also the Navichab mine, which is about 30 kilometers to the south of the Twin Hills project, and that's been in an on again, off again kind of sales process for the last couple of years. So if something does happen in that regard, somebody comes in, buys that, and it's an older mine, we're not quite sure what's left there. But if a buyer comes in, looks out the front door and sees a 2 million ounce, at least a 2 million ounce resource sitting outside the front door, it certainly kind of makes sense as a package deal or a tuck-in acquisition. But like I said, B2 seems like the logical fit. There's the history there. Operation is nearby, but really, with 2 million ounces, you're notionally looking at a plus 100,000 ounce per year producer for more than 10 years. That's attractive to kind of any mid-tier producer.
That's great. Okay, thank you, Ryan. Next question is in regards to real estate. So David, how will rising interest rates impact Killam's valuation and cash flow?
That's a good question. It will. There's typically a negative knee-jerk reaction to any sudden or unexpected moves in interest rates, but interestingly enough, over a medium to longer term time frame, you're typically seeing interest rates rise in response to or in anticipation of inflation. And what you see is on the cash flow side, assuming that the average term to maturity of the debt profile is staggered and long enough, you generally see cash flows rise faster than interest expense over the term of that debt maturity profile. Now, the one caveat being, it's not going to hit sectors equally. What you really want is short-term leases and long-term debt in an inflationary environment, so you can capture upside in market rents immediately while having a longer-term hedge against the rise in interest expense. So it's actually kind of topical for Killam, because in the multifamily space, you've got 1-year leases, which leads to effectively a half-year average lease term versus a 4 to 6 year term on the debt maturities. And also importantly, you want minimal exposure to rent-controlled markets, because you want to be able to capture the full market rent upside, not just the limited 2.5% that you might get in rent-controlled markets. So 70% of Killam's portfolio is not subject to rent control. Now, Nova Scotia's got a temporary cap because of COVID, but all signs point to that being eliminated once COVID's over. So the answer is really, you want to be in the multifamily space or in any space with average lease terms that are relatively short and allow you to capture that full upside.
That's great. Thank you, David. I think, Rob, we've probably got time for just one more question before we wrap up. And I think this is a really good one for Andrew. What is your outlook for federal cannabis reform in the United States, and how will this impact valuations in the sector? Curious to hear this one.
Yeah, it's a great question. Thank you, James. It's a broad question too, and I'd like to just try to talk about the federal situation just very briefly before I try to address that. So let me back up and touch on the current regulations in the U.S. Cannabis remains a controlled substance under the Controlled Substances Act in the U.S. at the federal level. Despite the federal rules, 37 states have legalized some form of medical or recreational use cannabis program, and more states are doing so all the time. Actually, in fact, just this morning, Alabama, which is home to 5 million Americans, just approved a bill for a medical cannabis program in that state, offering a multi-$100 million opportunity that didn't exist yesterday. And if you look at some of the largest states, of the 5 largest states by population, 4 of them have implemented some sort of medical or adult use cannabis program. So as of today, despite the federal rules, the majority of Americans have access to some form of legal cannabis, and legal cannabis sales in the US totaled more than $20 billion last year. So it's a very sizable and fast-growing market opportunity. So federal rules are not stopping Americans from purchasing cannabis from their state legal programs. Where is the upside to federal cannabis reform? And we see 4 areas that currently impact the industry. The first is banking. Companies today cannot access traditional bank loans such as mortgages and credit facilities, nor can they process credit cards. The second area is tax rates, where effective tax rates for many cannabis companies are in the 40 to 50% range and occasionally higher. A third point is access to major stock exchanges, where although many US cannabis companies have multi-billion-dollar market caps, they're not allowed to list on the NASDAQ or New York Stock Exchange. And a fourth area, a fourth pain point, is the high cost of capital these companies face, many of which pay interest north of 10% on their debt and a high cost of equity capital. So now, more than ever, I think we're hopeful that we'll see some sort of federal cannabis reform with the current regime, with the Biden administration, that addresses these 4 issues. If we see these 4 issues addressed, we think there's material upside to valuations across the sector, and we think we could see sharp increases as investors previously unable to participate in the U.S. cannabis opportunity are now able to enter the market and erase those market efficiencies. And so we're very hopeful that over the next 2 years we'll see some progress on the federal side of things, and hopefully we'll in the coming months we'll get an outline of what that plan looks like, and we're looking to the U.S. Senate to deliver an outline of how they plan to legalize cannabis at the federal level.
Solid response as always, Andrew. Thank you for that.
Thank you, James.
So Rob, we should probably start wrapping up here, but I just wanted to thank you and your team. I truly believe that one thing that differentiates Echelon from our peers in the industry is the cutting edge nature of our research, the ability for us to know where the puck is going, not to use a Gretzkyism, and really provide value at that front with early stage growth companies and also maturing companies. So keep doing what you're doing. The results are there. To our clients who are on the line, thank you for joining us again. I'll reiterate, these are not conservative investments. They are on the higher end of the risk continuum. So discuss those ideas with your advisor. Make sure that they have a home in your portfolio, and also ask questions of your advisor. The portfolio does change on a quarterly basis, so you'll be interested to see what is removed and what is added on a regular basis. So Rob, any parting words on your end?
Sure, and I just like to echo James's thanks. We thank everyone for their time, their attention. We really appreciate the opportunity, the privilege of reaching out to you with our thoughts and with our insights. And as James said, these are high risk, high return stocks. We do believe they have a place in a person's portfolio. As a team, we are committed to selecting the best names for our top picks portfolio. We are committed to this as an ongoing process. We would very much like to reach out again in the future. And, we thank Shelley and James for the sponsorship of this event. And, we wish you all the best, and we thank you for your time.
I hope it's as beautiful where you are as it is where I am right now. I'm going to go and have a nice dog walk. So have a wonderful evening, everyone. And thank you again for attending. Bye for now.